Comments made on the following paid commercial program are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time.
Welcome to the Money and Wealth Show. On the program this week, tax tips with David Ingram, money commercials, and our special guest, Dr. Doom, Marc Faber. Welcome to the Money and Wealth Show. I'm Sterling Fox, and our special guest this week is the man the American television networks like to call Dr. Doom. Dr. Marc Faber is in Vancouver visiting. How are you, sir?
Fine, thank you. Thank you for having me on your show.
It's a pleasure, Marc. We haven't seen each other
a long time.
For 5 or 6 years, I'm
yes,
thinking.
Yes,
could you do me a favor and walk us through, since the last time we saw each other 5 or 6 years ago, and what's happened as it might affect the next 5 or 6 years?
Well, I mean, at that time, I think we were in the midst of a housing bubble in the United States. And as you know, housing stocks, in other words, the shares of housing companies began to weaken after the summer of 2005. And then the subprime shares peaked out in 2006. And by 2007, it was even obvious to the Fed that they never considered that this was a big issue, that the whole US economy would be negatively impaired by the decline in the housing market. And so they pushed interest rates to zero after September 2007. And that's where we are today. And we had the bear market in 2008. And then since essentially between October 2008 and March 2009, asset markets around the world bottomed out. And then we had this huge rally. And this year, asset markets have become more difficult. Global liquidity has not expanded as much as before.
Right.
And so many markets are down after a huge increase in 2009. And now the big question is obviously, is this a correction in a bull market, which began in March 2009? Or was this whole move from the lows in March 2009 to the April 26 highs on the S&P at 1219, was this a bear market rally, and will we go down and make new lows? That is basically the issue here.
Right, and the speculation is about a double dip recession.
Yes, but I think this speculation has some validity. But look, in the US, whether the economy grows at 2% per annum or contracts at 1% per annum doesn't really impact the asset markets much. I mean, it's such a statistical issue to talk about this. It would matter hugely if, say, the economy were to expand at 5% per annum, on the other hand, contract by 5% per annum. That would have a huge impact. But whether we're either flat here, as I think we have a flat economy at the present time, and maybe we'll have a double dip, but the government, of course, they can continue to pursue their ill-conceived fiscal policies, namely the Keynesian policies of trying to offset contracting private demand with demand from the government, and they will continue to print money. That I'm sure.
Now, that's the theory that government can solve a problem by spending their way out of it.
Let's put it this way. Governments create problems. Governments are not there to solve problems. They're there to create problems and to take more and more power and freedom from individuals.
At G20 in Toronto recently, Dr. Faber, most member countries agreed, somewhat reluctantly, to the concept of at least debt reduction, spending decreases, that sort of thing. America seemed to be the most reluctant player at that table and signing on to that agreement. I don't think the Obama people are even interested in reducing stimulus spending.
Yes, I agree entirely. I think in the US, the stimulus spending will continue, and in my view, the fiscal deficits that, say, on an annualized basis, we're running at about $1.5 trillion in the last 12 months. In my view, they'll be going up over time to around $2 trillion annually. And as far as the eye can see, we'll never again have deficits of less than $1 trillion a year.
What then would you recommend as an alternative approach by the federal government in the U.S.?
Well, as I said before, I mean, I think the best would be for 50% of government employees to be sacked.
Okay.
To reduce government dramatically, to shrink the government, its involvement in the economy, and shrink the deficit dramatically. It would lead to some temporary pain, maybe 1 or 2 years, but it would be very beneficial for growth in the long run. Because look, with all the government regulation, if you're an entrepreneur, let's say you employ 50 people or you employ 10,000 people, are you going to build factories in the US with healthcare reform and a lot of uncertainty about taxation and this and that? Why don't you build it in India or in China or in Brazil or wherever it is? So I think actually the government's policies are a constraint on economic growth. They're not stimulating economic growth, quite on the contrary.
Almost driving business away.
Yeah, absolutely. And also there's a big uncertainty about taxation. I mean, what will you pay in terms of taxes going forward? You have no clue.
There seems to be...
I have a clue it will be more than what you pay today. But you don't know exactly how great a disaster it will be.
There's a pretty safe bet that
Yes.
the only direction taxes are going
Yes,
is up.
yes.
There seems to be a great deal of enthusiasm in Washington for a value-added tax, similar to Britain and many other countries on the
Yes.
planet, to generate new revenue to offset
Yes.
debt. What do you think?
Well, I think in general, since I studied financial policies, a value-added tax is probably the fairest tax you can have in a system because people really pay that tax where it's due. You can't roll it over to somebody else. But if you already have sales taxes, to add a value-added tax will just increase taxation, and it will actually burden, obviously, the lower middle class and the poor more than it burdens, say, the well-to-do people.
Our special guest this week on the Money and Wealth Show is Dr. Marc Faber, and we'll be back after this.
Good afternoon. My name's Larry Ray. I'm the President and CEO of American Manganese, Inc. I'm here to tell you today that American Manganese could possibly bring in the lowest cost electrolytic manganese metal mine in North America. It'll be the first one in the past few decades. What is manganese? Well, you can't have a steel industry without manganese. If you don't have manganese, you don't have steel. If you don't have steel, the world stops. North America has no manganese. We depend on our neighbors and other countries to import our manganese, and it just doesn't make any sense we don't exploit the resources in our own country. So I'm here to tell you that we are moving ahead with the feasibility study, we're moving ahead with the environmental studies, and we're moving ahead with a massive drill program in order to build the American Manganese, Inc. into the first primary electrolytic manganese producer in the United States. Please visit our website at americanmanganese-inc.com or call us at 604-531-9639. Thank you.